W-2 income is the most heavily taxed income type in this country. And I know that sounds like something that you'd read in a financial blog, but it's really just structurally true. Let's say there are two executives from the same company, same title, same salary, same equity comp package, and even the same bonus. If you looked at their comp statements side by side, you wouldn't be able to tell them apart. But last year, one of them paid $340,000 in taxes, while the other paid $218,000. A $122,000 difference on identical income. And it was completely legal. The difference had nothing to do with loopholes or anything aggressive that would make your compliance team nervous. It came down to one thing. One of them had a coordinated strategy built around their entire income picture before the year started, while the other had a CPA that showed up for them in April, filed the return, and moved on. That's genuinely it. Because you typically can't time when W-2 income hits. You can't control the character of it like a business owner can, and you can't defer it like an investor can. The tax code was simply not built with you in mind. And I know this because I once was a W-2 executive leader. But there are 5 levers you do control. And by the end of this video, you'll know each of them. Let me start with what I call the tax stack. When $1 of W-2 income hits your paycheck, it doesn't just face one tax. It faces several all at once. At the federal level, you're at the top marginal tax brackets, whether that's 22, 24, 32, 35, or 37%, depending on where your income lands. And if you're in a high tax state like California, New York, or New Jersey, add another 9 to 13% on top of that. Then there's FICA, or payroll taxes. Most people think of FICA as a small line item on their paycheck. At high income levels, the Social Security piece phases out, but Medicare doesn't. And there's an additional 0.9% Medicare surtax that kicks in for single filers above 200K and joint filers above 250. Let's look at this example. Say you're a director at a tech company in California, and your base salary is $400,000. A bonus hits in Q4 of $75,000, which is great, but here's what actually happens to that $75,000 before it actually hits your account. Federal income tax takes about 37% off the top, so that's just under $28,000 gone immediately. California adds another 13.3%, which is just under $10K. Then Medicare is 1.45% standard plus the 0.9% surtax because you're already over 200K, so roughly add another $1,700. You started at $75,000, then after taxes, you're taking home roughly $35,500, literally less than half. And here's the part that really stings. You didn't choose when that bonus hit, and you certainly didn't choose the tax character. You didn't get to hold it, time it, or structure it. It just landed, and the tax stack came down on it immediately. The point here isn't to get lost in the brackets. The point is that multiple layers are hitting the same dollar immediately and with almost no ability to redirect it. The word immediately is key. W-2 income is recognized the minute you earn it, vest it, or receive it. You don't get to decide when it's taxable. It just is. Now contrast that with how business owners and investors experience income. A business owner can structure compensation strategically, control timing, and run expenses through the entity, and design retirement plans that drastically reduce what flows to the IRS in a given year. An investor with a diversified portfolio can choose when to realize gains, holding appreciated positions until it's advantageous to sell, qualifying for long-term capital gains rates, or managing realization year by year. Pass-through real estate investors can access depreciation and other structural features that offset income in ways that W-2 earners simply cannot. This isn't about loopholes. It isn't about cheating the system. It's about income characterization and control. Business owners and investors have more of both. W-2 earners, even highly compensated ones, have less. Now let's get into the 5 tool buckets. But if you're already earning $500K or more, and you want to see exactly what a coordinated strategy could save you this year, the link to book a wealth strategy call with me is in the description below. So what do you actually do about it? I'm going to walk you through the 5 tool buckets because W-2 earners have fewer levers than business owners or investors. And that means that execution on the levers that you do have matters more. Tool bucket 1 is max out every tax advantage account available to you. Now, this sounds obvious, but I'm consistently surprised by how many executives in complex comp situations aren't doing this completely. Your 401k up to the IRS limit, and if you're over 50, the catch-up contribution on top. Your HSA, if you're eligible through a high-deductible health plan. Most people treat the HSA like a healthcare spending account, but it's actually one of the most powerful retirement vehicles available. Contribute pre-tax, invest and grow tax-free, and withdraw tax-free for qualified medical expenses now or decades from now. That's a triple tax advantage almost nobody in your income range is fully using. And if your 401k supports it, and check this carefully because not all do, there's a strategy called the Mega Backdoor Roth that allows you to contribute significantly more than the standard limit into after-tax Roth dollars. If your plan allows it, and more plans are now offering it, this is real money compounding over time. Tool bucket 2 is non-qualified deferred compensation. If your employer offers a non-qualified deferred comp plan, this is one of the most meaningful timing levers available to W-2 earners. The basic concept: you elect, before the compensation is earned, to defer a portion of your salary or bonus to a future year. And that defers the income recognition and the tax bill. There are important nuances here around plan risk and distribution timing, and elections typically have to be made before the calendar year begins, sometimes earlier. The window matters. This is a plan ahead in the fall decision, not an April decision. Tool bucket 3 is charitable structuring. If you give to causes you care about, you could be leaving significant tax efficiency on the table. A donor-advised fund, often called a DAF, lets you bunch charitable contributions into a single high income year and claim the full deduction that year. RSU heavy year, bonus heavy year, that's often the year to give. Even better, if you own highly appreciated securities, donating them directly to a DAF instead of selling them first means you avoid capital gains entirely while still getting the deduction. This is a values-aligned strategy, not a tax trick. Tool bucket 4 is asset location. This one is quiet, but it's real money over the course of a decade or more. Asset location isn't about what you own, it's where you hold it. Tax inefficient assets that generate ordinary income, have frequent distributions, or short-term capital gains belong inside tax advantage accounts where they're shielded. Tax efficient assets like index funds, buy and hold equities, or muni bonds can live inside taxable accounts without generating unnecessary annual tax drag. Most executives with multiple account types aren't thinking about this deliberately, but when you do, it adds up. Tool bucket 5 is equity compensation timing and coordination. This is where I see the most expensive, unforced errors. RSUs are straightforward in structure. They vest, they're ordinary income, you pay taxes on them. But the coordination decisions around vesting, whether to hold, when to sell, how much concentration risk to carry, how the vesting interacts with your other income, those decisions have real consequences. And for executives with ISOs, there are additional layers around alternative minimum tax, timing of exercises, and the difference between qualifying and disqualifying dispositions. Most of these decisions can't be made intelligently in isolation. They need to be mapped against your full income picture, your state tax exposure, your charitable plan, and your timeline to become work optional. Multi-year coordination is what separates a reactive equity plan from a strategic one. Now, here's the reframe I want to leave you with. You can't change your income type, at least not immediately, but you can build a system around it. Most executives that come to us don't have a tax strategy. They have a CPA that files a return, and those are not the same thing. A real tax strategy for a W-2 earner is a multi-year system coordinated across your benefit elections, your equity decisions, your charitable giving, your retirement accounts, and your investment structure. It's not an April event, it's a cadence. And when you run that system deliberately, the gap between what you're currently keeping versus what you could be keeping is often between $50,000 and $150,000 a year at the income levels I'm describing. The executives who keep more aren't smarter, they just have a system. If you want to see what that looks like for your specific situation, there's a link in the description to book a wealth strategy call. We'll map exactly where your money is going and where it doesn't have to. Book a call now.